Most people think trading is about being right, right about direction, right about timing, right about the big move everyone else missed. But the market has a quieter way of humbling people, not with crashes, not with headlines, with friction, small, almost invisible friction. And that friction lives in a place most traders barely look at, the bid-ask spread. As this first slide sets the tone, notice the words, a hidden cost, a silent signal, a trader's edge. That's not poetic fluff. That's literal. Because whether you're investing, trading, or building a business, the people who win long-term don't just chase upside. They manage friction. That's the core idea we'll stay anchored to the entire time. Success compounds when you reduce friction, not just when you chase opportunity. Keep that in mind as we move forward. Now, shifting focus to what we'll explore together, this isn't about turning you into a market technician overnight. It's about learning how a small structural detail quietly shapes profits, decisions, and discipline. Because once you see it, you can't unsee it. And this applies far beyond trading. Here's the uncomfortable truth most people don't like hearing. Two traders can make the same decision at the same time on the same asset and get very different results. Not because one is smarter, but because one understands cost. This brings us to the idea on the next slide, the cost you rarely see. Most traders stare at charts, candles, indicators. Professionals stare at execution. They know that every action has a price attached to it, and the bid-ask spread is where impatience quietly pays a tax. Think about it. If you rush into a trade, you accept the worst available price. If you slow down, you negotiate. That difference doesn't feel dramatic in the moment, but over time, it's decisive. This is where the conversation stops being about markets and starts being about behavior. Building on that idea, let's ground ourselves in definitions, not theory-heavy ones, just reality. On this slide, we meet the two characters behind every trade, the bid and the ask. The bid is what buyers are willing to pay. The ask is what sellers are willing to accept. That gap between them, that's the space where decisions happen. That's where fear, urgency, confidence, and patience all collide. Every single trade you've ever placed happened inside that space, even if you never consciously noticed it. And this is important. No one is wrong here. Buyers and sellers are simply negotiating value in real time. The market isn't judging you. It's offering terms, which leads us naturally to defining the spread itself. The bid-ask spread is simple on paper. Ask price minus bid price. That's it. But simplicity doesn't mean insignificance. That number is your immediate cost of participation. It's the price of entry before the trade even has a chance to work in your favor. A small gap signals trust, activity, liquidity. A wide gap signals hesitation, risk, uncertainty. This isn't abstract. This is the market telling you how comfortable it feels right now. And here's where things get interesting. Shifting focus again, liquidity tells the story behind the spread. In highly liquid markets, think large, that well-known stocks, buyers and sellers are plentiful. Competition keeps spreads tight. Everyone's comfortable. In thin markets, penny stocks, obscure tokens, low-volume options, the spread widens. Not because the asset is bad, but because fewer people want to take the other side of your trade. This is a lesson entrepreneurs learn the hard way too. When demand is thin, you pay more to move. When demand is strong, friction disappears. Which brings us to volatility. During calm periods, spreads behave. During uncertainty, they expand. Market makers aren't villains, they're risk managers. When the future feels unclear, they widen spreads to protect themselves. Breaking news, earnings, economic shocks, all of these moments stretch the gap. And this is where discipline starts to matter. Because when spreads widen, the market is effectively asking you a question. Do you really need to act right now? Most people answer emotionally. Professionals answer strategically. Now pause here for a second, because this leads directly into the real cost to your profits. You don't need to lose a trade to lose money. That sentence alone changes how people see markets. Frequent trading combined with wide spreads creates silent erosion, death by 1,000 cuts. Not dramatic enough to scare you away, just consistent enough to keep you stuck. This is why so many people feel busy but not effective, active but not profitable. And again, this isn't unique to trading. In business, friction looks like inefficient processes. In life, it looks like unnecessary urgency. In markets, it looks like the bid-ask spread. Now let's ground this with something concrete. On this slide, the contrast is clear. Buying Apple stock might cost you 5 cents to enter. Buying a volatile crypto asset during chaos might cost you 2 or 3% instantly. Same click, same action, completely different outcome. And this is where awareness becomes power, because once you see that context matters more than conviction, you stop forcing trades, you start selecting environments, which naturally leads us to patience. Price is what you pay, value is what you get. This quote gets repeated often, but spreads are where it becomes real. Understanding spreads trains patience. It forces you to wait for better terms instead of demanding instant gratification. It rewards those who slow down when others rush. And that's not just a trading lesson, that's a life skill. At this point in the deck, something shifts. You move from understanding to application. This is where the engagement enchanter level kicks in. Practical doesn't mean complicated. Using limit orders instead of market orders is one of the simplest ways to reduce friction. You're no longer accepting whatever the market throws at you. You're setting terms. Trading during high volume hours narrows spreads naturally. Favoring liquid assets reduces execution risk. None of this requires prediction. It requires awareness. And here's the key. These habits compound quietly. Now let's slow down again. This reflection slide isn't filler. It's where the lesson sticks. Where have spreads quietly affected your results, not just financially, but behaviorally? Where have you rushed? Where have you paid extra just to feel done? And what would change if patience became your edge, not just in markets, but in decisions? As we move into the final thought, bring everything back to the core idea. The bid-ask spread is not a technical detail. It's the market's mood, priced in real time. It reflects confidence, fear, liquidity, urgency, and trust, all in a single number most people ignore. When you learn to read it, you stop reacting. You start choosing. You trade from clarity, not urgency, from awareness, not impulse, and that mindset transfers everywhere. If you found value here, take a second to subscribe, hit the thumbs up, and grab the PDF linked in the description. It's built for offline reflection and practical application, something you can actually use, not just consume. Remember this one idea. Long-term winners don't just chase opportunity, they remove friction. Start there, and let everything else compound.